Welcome, everyone, to the 911 Real Estate Call. Whether you're a doctor, managing patients,
a business owner, running operations, or an entrepreneur balancing multiple ventures, this space is designed for you.
multifamily real estate investing can seem overwhelming,
But today, we're here to make it simple and easy to understand. Together, we'll dive into real deals, discuss strategies, and exchange ideas to help you grow your portfolio and generate true wealth.
This call isn't just about properties, it's about building strong connections and creating long-term financial success.
Let's jump in and unlock the next step in your investment journey.
Our guest today needs no introduction. He is a friend and a mentor to many. He has been doing multifamily real estate for, oh my gosh, over 10 to 12 years and has been very, very successful at it. And he is here to let us know not only what he's currently doing, but also to give us a different spin, because crypto is one of the things that Alex and I, when we've talked, has always fascinated us. So we are excited to hear his knowledge, and there's no one better, I think, in our MIH family to talk about that than our very own Josh Stahl. So Josh, please take it away. The floor is yours, my friend.
Thank you. I appreciate it. I appreciate you guys having me. I love talking about this stuff. It's kind of what pings around inside my brain all day, every day. I find real estate and crypto and macro just fascinating in general. So I guess where I would start is I do have a brief presentation, but let's talk about the macro environment a little bit. I know that over the past few years, real estate prices have gone up. I know that some people think, oh, maybe we're in like a real estate bubble. And then you look at the S&P 500, that's up. You look at tech stocks, they are up. You look at any asset and it is, within the standard deviation of its all-time high. I mean, that's commodities, that's a lot of things. So, I was kind of operating on the thesis of, maybe it's a bubble for everything, you know? But then you look at things like services. Every service has gone up. Commodity prices have gone up. Beef, go to the grocery store. Groceries are more. So I think we can probably officially say at this point that we are in a declining dollar environment. I don't think from a macro perspective there's any kind of way around that. So asset prices, I think, will probably go up for quite a while. I just don't see um, anywhere where there's like an asymmetric bubble that's going to pop. It looks like it's just devaluation of the dollar. All asset prices are going to go up. Services are going to go up. Food, commodities, everything will continue going up until there's some sort of inflationary deleveraging. So that's kind of the thesis that I'm operating on. And why did I start with that, right? The reason I start with that is if we are in an environment where the dollar is devaluing and asset prices are going to go up, you need to be looking for a risk adjusted return for your portfolio where some of it is conservative and then some of it you can get asymmetric return far beyond what the devaluing of the dollar is going to do. So that is one of the reasons that I love crypto. So if you could, can I share my screen?
Josh, let me give you share screen. You should be good.
Okay, great. Give me 1 second here.
Mm-hmm.
I don't know why it's not working.
Yeah, I gave
There we go.
there we go. Yep. Yep, I got you. We got you.
All right.
We're on.
So this is why for my portfolio, I use the real estate and crypto barbell strategy. So I think some people are probably saying, what is a barbell strategy? The basic concept behind it is have a majority of your assets um, in a conservative position, and then some of your assets in a very risk on, more asymmetric um, position, and don't try to mid curve it. So nothing in the middle. So that's why they kind of give you the visual of the barbell. Um, I know that all of you probably invest in real estate, so I will probably breeze through some of this stuff because we know that real estate provides stability and income and tax advantages. It provides an asset that appreciates in an inflationary environment. It appreciates over time. Other people are paying for it. So we love this, and it can provide the base that you need for sustained long-term wealth building. So crypto, it provides growth, innovation, and asymmetric upside. It also provides cash flow if done properly. It also provides the ability to borrow. I know that a lot of people love real estate because you can take out leverage. You can do the same thing with crypto. I've taken leverage against my Bitcoin holdings to buy buildings. Not the hardest thing in the world to do. Combined, it gives you resilience, and you know you can ladder your liquidity over the short term with crypto and over the long term with real estate. Um, just briefly, another rehash of kind of why we like real estate. You can get predictable cash flow. It's an asset that is backed with leverage opportunities. I don't know how many people have done their taxes and own a lot of real estate, but I tell you what, I'm always very, very happy when my tax bill is decreased by hundreds of thousands of dollars because I bought something into the cost segregation. It is one of the best things that you can do for your long-term investments is just keep buying good opportunities and leverage not having to pay the government a lot of money. It's bottom line net dollars right in your pocket. Um, Value add and appreciation potential. I would say that right now, value add is a little bit of a double edged sword. There aren't a whole lot of really great value add
Hey,
properties
Josh,
out there that
sorry to interrupt you, my friend. Are you changing the slides as you're talking, or
I
I just
am.
wanted to make sure? Okay,
Yep.
okay, we're not, I guess we're not seeing the changing of the slides. I just wanted to make you aware.
Oh, sorry about that. I don't know
That's okay.
why.
No biggie. There you go. Yep.
You see it changing now?
Yep. We're on why is a barbell strategy. Yeah. Yep. Safe
All
side
right.
real
Need to
estate.
be on the
Yep.
safe
We're
side.
good.
Yep.
Yep. Okay.
Okay. Um, yes. So value add and appreciation potential, tax advantages, depreciation. I don't know if people are using 1031 exchanges. Also good. Um, Value add. I think we all need to be careful right now. There is a lot of overpriced assets in real estate because people are distressed or they're trying to get out of properties that haven't done great for them that maybe they bought in the last 3 to 4 years. So just be careful with value add right now. I think my personal philosophy is if I want to do something value add, I want to be able to budget to replace everything. So I'm looking for the worst of the worst, the most derelict properties, so that I know I'm not going to blow my budget at all and I can be correct in my underwriting. And then I guess one of the other major things, multifamily, low volatility. I mean, we all know that over 20 years it's going to go up. If you're buying in a good market, you should have good demographics, you should have good jobs numbers. You should have safe, reliable appreciation and cash flow. All right. Can you see that I changed the slide?
Yeah, you're good, Josh. Yep, we can see.
All right,
Yep.
good. Um, why crypto? Bitcoin. I've been buying Bitcoin since 2016. Buying and selling it since 2016. Initially, when the crypto markets were in their infancy, you would just buy a token and hold it and cross your fingers and pray for it to go to the moon. As crypto became more complex and people started figuring out that there were a lot of different things that you could do on the blockchain, people started doing things like offering you rewards for staking your crypto, offering you, you know, an interest rate for lending your crypto, allowing you to borrow against your crypto, allowing you to provide liquidity to other people to swap and or trade and get paid fees and revenue to do that. So you can treat your crypto like a de facto kind of bank. You can loan, you can have, secured loans. There's a lot of things that you can do, and you can do them and receive yields that are asymmetrically better than anything you can get from any other financial instrument. So I think we can probably all agree that a good yield on a multifamily stabilized A class asset is probably in the 6 to 8% range. I can get 20 to 30% yield on my crypto, remaining relatively safe. So to do that in multifamily right now, I know that Eric and I were kind of talking a little bit before the call that things aren't penciling. The yields maybe aren't there. They're hard to find, or you have to find something that is a very derelict property and probably put 18 months of your time and energy into it to turn it around. And you're managing people, you're managing a budget, you're managing risk over a period of time. And when done, maybe you'll get a 12 or 15% yield um, after 18 months and after a lot of risk. I can do that in 20 minutes in crypto. And I have access to my liquidity whenever I want it. It's not like I have to wait for a liquidity event. I don't have to refinance my property. I don't have to sell it to get access to all that liquidity. I can jump on the internet and I can liquidate my position in 15 minutes or borrow against it and have my liquidity back. Um, One of the other things about crypto that is good is there are always different ecosystems popping up. So one of the latest ones is Hyperliquid, and we, my partner and I, just used that platform and traded on it. And we weren't trading huge amounts of money. I think we traded probably over the course of 6 months, maybe $50,000 in trades. And they rewarded us for using their platform by airdropping us $20,000 just for using the platform. It was $20,000 in their token, right? So you cannot get upside like that in real estate, and we got that just for using their platform. It wasn't like we were holding their token or accruing a lot of risk by holding their token. It was just to use it and help them market their platform. And then I guess the other big thing is you can see the chart. um, you know Crypto over the last 10 or so years has vastly outperformed any other asset class. And certainly if you're getting yield and compounding it back in, you're going to 5 or 6x what you're doing in any other asset. So here are some portfolio structure examples. Um, I would say that for my personal portfolio, I am vacillating between balanced and aggressive. It really depends kind of on market cycles in real estate and market cycles in crypto. And the other thing, excuse me, that has affected it for me is, I'll give you an example. So this year we have, kept our hyper liquid that we got airdropped. It has grown in value from like $6 a token to like $55 a token. So it has skewed kind of where our portfolio is. So right now, I think we're probably in the more balanced um, portfolio where were more conservative. We were a little more bearish at the end of 24. So we are waiting for opportunities to, liquidate some of our crypto and maybe get back to more conservative. Um, but yeah, that's kind of where we are right now. I think one of the other big things that people don't think about pursuant to real estate or crypto is how to manage your risk. My personal portfolio in real estate, yeah, it can reduce your downside exposure, but it also can't if you don't structure your deals right. So when I'm buying a real estate deal, I'm looking to get on fixed debt. I want a long term on my fixed debt. I want to make sure that I'm paying off some principal over the course of the loan. So I'm paying some of the debt down. So when I go to refi, I'm not only relying on appreciation, I'm not only relying on whatever my business plan is to increase the rents. Things happen. You need to be pulling all the levers to de risk your property, especially if you're taking other people's money and you're being a good fiduciary to them. If it's just your money, feel free to do whatever you want. But if you're taking other people's money, you really need to be looking to reduce reduce risk. And so the other big thing about reducing risk across your portfolio is you have to be cash flowing um, within whatever your allotted time is on your business plan. I understand that you might buy a value add deal, you may be fixing it up, it might take 2 years, but once you are at your 2 year pro forma, we should be kicking off cash. You need to kick off cash. Um, so I guess the other thing to mention here is crypto, if sized properly, you can have a lot of asymmetric upside potential without a huge risk of your whole portfolio collapsing. So even if you just want to take 5% of your portfolio, you can be in relatively safe things with a lot of upside, and you don't have to risk anything else. You can be in safe things like real estate. I think I mentioned this previously. Liquidity ladder to me is important. I like to have my liquidity coming back to me across different time horizons. I think this is something that a lot of people maybe don't think about. If you can ladder your liquidity out over the short term and over the long term and plan it really well, then you can plan your acquisitions a little more reasonably and get the maximum amount of um, tax write offs possible. So I would encourage everyone to really plan out their portfolio and really look at laddering their liquidity um, and laddering it out in years where they're going to have big cost segregations and you know, big tax benefits. Um, Hedging tools. I'm not going to get too far into the weeds, but on on chain and crypto, you can just lend what are essentially digital dollars and get 15 to 20% yield. Obviously, fixed rate debt, if you're in real estate, is a huge hedging tool. You know what your exposure is, you know what you got to make on the property. You don't have to worry about your rate changing. And then strategic advantages. Oops. Um, I think the big strategic advantages. Did I skip a slide? I did. Hold on a second. Yes, case study. So this is an example of what, starting with $1 million, what you could potentially do with the balanced portfolio model. So I think you can see the yellow line is for crypto. That represents a portfolio value of $300,000, growing at 25% a year, which is reasonable with crypto. And that's compounding the returns back in. So over the course of 5 years, you can 3x a crypto portfolio pretty reliably and in a pretty risk off way. And then obviously the green line is multifamily at a 7% kind of annualized return being compounded back in. So you can see that you can also, on a lower risk asset, do quite well if you have the ability to stay in things for 5 years, the ability to continue acquiring things and compounding your money back in and getting returns. But the message here is two things. You need to stay in it for a few years. You need to have a good business plan, and you need to get to your 5 and 10 year marks to really get the appreciation that you want. You need to be compounding money back into your assets, and you need to use a barbell strategy, in my opinion, to get the reliable and the asymmetric returns that we all really want. So strategic advantage, pretty simple slide here. We want diversification. We want cash flow. We want liquidity and access to liquidity. And, I think on crypto, you want to be in some of the newest tech and some of the most innovative stuff as the world changes. And that is what I think the modern wealth model is in the current macro environment that we're in. So, stability, protection of principal, slow growth with yields in real estate, and then, a little risk, but asymmetric upside potential with using cryptocurrency. All right. I'm going to stop share.
Josh, that was awesome. And before we get to the questions, because I know that there's many, I just need everyone to turn on their camera so that we can take the picture. I know that Alex probably says it much better than I do, but I just need everyone's screen on so we can get our photo, and then we can get on to the business of picking Josh's brain even further. So Anne, if you would like to take the picture for us, that would be fantastic.
Okay.
Awesome. Go ahead on your cue. We'll say cheese on your cue.
Okay. Say, cheese, 1, 2, 3, smile.
Cheese.
There you go. Thank you.
All right. Thanks so much. Josh, that was a fantastic presentation. I have one question. This is going to seem so elementary and basic, but where do you hold your crypto? I mean, there's so many different places to hold your crypto these days. Where do you hold it?
I think you answered it with the question. I hold it so many different places. Um,
Okay.
that's kind of one of the management issues with crypto. There are applications and protocols where you have to keep your money on their application. So there are also online wallets, so you can access it anytime you're jumping on the internet. There's offline wallets. I guess it just depends on what you're doing with your crypto. I would say the vast majority of my crypto right now is locked up in applications online, earning me yield.
Okay. Okay. I guess do you is one have you found one online application better in terms of service, security, etc.? Like, what are the criteria you use, I guess, to determine what is the best online storage space?
Well, I think
If
Coinbase
that
is
can be
fine.
answered.
Yeah, I think Coinbase
Yeah.
is fine if you're just going to buy and hold.
Hmm.
And then I
Okay.
think if you are looking to get different yields and things. So I use this website called DeFi Llama. It'll show you kind of interest rates across different protocols, but you can search their data for things that have been audited. You can do your own research on who audited it and just make sure that you're dealing with reputable people.
Got it. Okay, before I start asking more questions, please, does anybody have any other questions for Josh?
Hey, Josh. Good morning. Thanks, guys,
Hey, Sip.
for putting this on. Josh, I got three questions, and they're pretty. First of all, you're referring to as we. Do you have partners in this crypto thing, or are you just referring to we like
I,
to
I
yourself?
I do have a partner. My son is an investment banker. He he's been working with me for 2 years. So we do typical kind of investment banker analysis on the tokens that we choose to buy. So we look at strengths, weaknesses, opportunities, threats. We look at the tokenomics of something. We look at the business plan. We present to each other, and then we yell at each other and argue, and then we decide what we're going to allocate or not allocate towards the different assets. We do the same thing with kind of the applications and protocols that we want to get yield from. So it is definitely a team sport for me because a real estate's a little more like in a box, right? You underwrite it, it makes sense. Anyone else can look at it and see if your assumptions are good. Crypto's definitely more of a black box. You definitely have more blind spots because you have to look at more things. So having someone knowledgeable helping you is definitely
Yeah, Josh,
optimal.
you just led right into my second question, right? So, how much time do you invest in it, and also, where did you get educated? But I think that your son being an investment market, I guess that that helps in that aspect.
Well, I've been doing it
Because I
way
mean,
longer than he's been an investment banker. I would say, let me think. I have kind of been in the trenches since crypto got popular, so a lot of it's do your own research. I let me think. I belong to DeFi Dojo, their Discord. It's a paid Discord. A lot of people in there are researching protocols, using them. There's also another one, the Humble Farmer Discord, another guy who um, is just vetting out projects and looking at yield. On YouTube, there's a great channel called Finematics, Finematics, I believe. And it just explained things like lending and borrowing in crypto. It explains liquidity pools and liquidity provisioning. It explains leverage. So you can certainly do a deep dive into all the different types of things that you can do in crypto. Um, It'll probably take a solid 6 months of pretty diligent research to feel like good about kind of all the things you can do, understanding how they work, all that stuff. I'd say, typically people just say, "Oh, Josh, what crypto would you buy?" I think that's like maybe the least important thing. I think the most important thing is knowing how everything works and knowing how you can use all the different kind of financial tools to actually make money.
thanks, Josh. Appreciate it.
hmm
Jay, I know you had a question, my
Yeah.
friend. Go ahead.
I do have a couple of questions, and Josh and I talk almost every week, at least every other week. So it's always good to have a sharp mind to bounce ideas around with. And
For like 3 or 4 years now. It's been a long time,
yeah,
friend.
absolutely. But I think, I still haven't really made use of any of your acumen when it comes to Bitcoin and crypto. We usually end up talking mostly about real estate. And I started investing in crypto in 2018, 2019, when we had that initial spike, and sold everything off when the prices start to, crash essentially, right? I think I remember the first time Trump and Hillary were going against each other. That's when it happened. And at the time, I had made a decision that I'm going to not invest in anything that I don't understand. But I think I've now come to a realization that I think would probably understand this and get into it, because there's definitely a case to be made about crypto. So, Josh, when it comes to crypto for beginners, Finematics is a wonderful resource that you shared. So I'll start looking into it as well. Would you recommend just DCAing into ETH and BTC? Maybe the returns are not as good as some of the newer stuff that you're getting into, but is that something that you would recommend beginners to get into? Just using Coinbase, allocate 100, 200 bucks every day and keep putting money into ETH and BTC. So that's my first question. And I do have one more question for you. Go ahead.
Yeah, give me your second question too, and I'll handle them both in one
Yeah, the
response.
other question I had was around, not around crypto, but more around your thoughts on precious metals. And do you
Okay.
invest in gold or precious metals, and what you think are the pros and cons, given
Sure.
currently there's a lot of talk about precious metals as well?
Sure. My initial forays into crypto were all using dollar cost averaging. So I was buying $100 or $200 of assets that I liked every week for years. So I think that buying Bitcoin, using that strategy and getting kind of the average price over 4 years is the best thing to do for a beginner. I would agree with that thesis. Ethereum, we're seeing more and more institutional adoption. We're seeing inflows on their ETF that are really big. I think that it's wise to dollar cost average in to that asset as well. The one thing I would say is dollar cost averaging is great to maximize your purchasing whenever you feel like crypto's dumping and there's blood in the streets. That's when you maybe want to make a big purchase at some point. It's kind of like, um, you know, when asset prices get to a point where you start feeling squeamish, that's when you need to buy them. You know, so I bought the dip a few times, but I mean, let me be honest. I've had years where I've made. I mean, 2024 we made 7x on our money. In I can't. When did Luna collapse? Whatever year Luna collapsed, I lost like $60,000 in one day in like 3 hours. So like, you know, you gotta be buying good opportunities, and you have to understand that volatility is your friend if you want to get yield and make money, with lending and borrowing and stuff, but it also is going to hurt at some points. So dollar cost averaging in is kind of the best strategy because you're amortizing your purchasing over a longer period of time and getting kind of that average cost. Gold, that is a good question also. The only thing that I'm doing with gold right now is there's a gold-backed cryptocurrency called PaxG. So they basically, for every dollar you put in, they're buying and storing gold. So I bought PaxG, and I am taking a portion of my PaxG tokens and a portion of stable coins and providing that in the liquidity pool. And I'm getting about 17% return on that for providing liquidity for people to swap and trade and do things. So I'm holding exposure to gold, but also getting yield on it via the blockchain.
Awesome. And when you mentioned buying in the dip, so BTC went from, I think, 120 to 107. Now it's back at 116. Would you say 107 was a dip? Or are you literally waiting until
I would say
value
a real
drops by
dip would
30, 40%?
be 80. A real dip would be
Okay.
80.
You see that happening maybe at some point?
Um, I think that's a tough question. I think with the current macro environment and I mean, like I said at the beginning, everything is still going up, and I thought for a while it was an asset bubble, but now that services and commodities and beef and groceries and everything is more expensive, it's hard to say that it's a bubble and not just devaluing of the dollar. So I'm operating on the thesis of in a devaluing of the dollar, what are the things that I want to own?
Yeah,
So the price of Bitcoin is maybe not the first in my hierarchy. It's not the first consideration.
makes sense. That's super helpful, Josh. I think one of the questions that Sip had when you said we. So yeah, if you're open to JVs, let me know. Or if you can create an app where the app can just emulate your moves, I'm willing to pay $9.99 a month as a subscription for it.
Start a
I'll
Substack,
let you
Josh,
know.
for us.
Basically an MIH crypto fund.
Right.
That's exactly what I was gonna say, Eric. Yeah, just start a
Were
fund.
you really? Yeah, I mean,
We're
that's what
in.
I was
Yep.
thinking too. That's funny. Right.
I have a question in regards to tokenization of real world assets. When we see when this is going to start getting adopted a lot, and it'll take a lot out of being more global with your capital raising for your real estate investments. And it seems like a lot of those tokens are backed by Ethereum as well. And how do you see this playing out? Like, how soon do you think it'll be more widely adopted that we're going to start providing tokens instead of raising US dollars?
I think that I think there's people who are going to do it right, and I think they'll do it prematurely. The thing that I get most concerned about with fractional ownership of real estate on chain is how are you securitized? You know, if you're buying into a syndication or you're getting into a JV, you have an operating agreement, you have a deed, you have closing statements, you have all these other things, right? If you're on chain, yeah, you might have a smart contract, but there's still aren't really companies that are securitizing title on chain and things like that. So it's still kind of the wild west on the security side. However, people will do it and people will sell fractional real estate online. And I think you'll be taking chances, fractional real estate on chain. And I think you will be taking a chance. But I would say in the next 5 years, someone will have the security part of it figured out. So you have access to title and settlement statements and all the other things you need to actually make a decision to invest. I think it will probably remain on Ethereum blockchain. I think we're seeing while I don't love Ethereum because I transact a lot and I'm more sensitive to how fast and slow things are and more sensitive to the fee structure. Um, on big institutional things like real estate, I think Ethereum will be fine, and I think institutional investors have bought enough Ethereum where they've said categorically we're placing our bet here. So, yeah, I think it remains on Ethereum. Be careful about the security of tokenized real estate.
Awesome.
Anyone else have any questions for Josh? Do not be afraid. No question is a bad one.
I don't have a question, Eric.
Oh, go ahead. Go
Hey,
ahead, Seb.
yeah, listen, but I mean, honestly, I think what Jay just brought up is actually like a really like idea, a really cool idea you should explore. Like, would you be willing to like start some kind of a crypto fund? And I know that's I don't want to put you on the spot, but like this, you make it sound like I mean, I don't want to say it's simple, but some of us have very demanding jobs, running businesses, whatever it may be. I do not have the bandwidth for that. Like, this isn't even a conversation starter for me. Like, I held a little bit of Bitcoin in Coinbase, and that's my exposure, period. I have no interest in learning like the whole, like just getting into the weeds like you, period. But I would absolutely be interested in investing money with you in a fun style, right? Knowing that this is my high risk investment, you know what I mean, blah blah blah, the whole thing. So just something to consider, Josh. And I'm glad Jay brought it up.
Yeah, I appreciate that. I've definitely been asked about doing it many times. It is, it's something to consider. I think there's SEC rules. There's a lot of things that the upside would have to be really big to take on all of that risk in the fiduciary duty, right? So there'd be a minimum amount that the fund would have to, be able to get as far as investors for me to consider it. But it is something I have thought about. Um, yeah, I think one of the reasons that we haven't really pulled the trigger on doing that, in all honesty, is it is definitely a full-time job managing other people's money. And I don't know why you guys are in real estate or in any other investments. For me, it's definitely not to work 80 hours a week. So it's a definitely maybe, I guess, would be the answer to that.
And anybody, to your point, Josh, anybody who has thought about exploring a fund or has a fund knows all the proper steps that you have to go through with SEC attorneys just to make sure it is an undertaking. And I know I do not have a fund myself, but I've been exploring that for the last 2 to 3 months, and it is a lot. It's not impossible, and it can be worth it, but you're absolutely right. For the amount of work and expense that you have to go through to set it up properly, the returns have to be there.
Yeah.
Yeah.
Yeah, for sure. Um, I mean, I do invest in real estate also. I know everyone else does too, but uh, if there's any questions about real estate or the current real estate market, I'm certainly open to those. And
Well, that was actually
the
my
kind of
next question.
portfolio. Yeah, go ahead.
Yeah, for you, Josh, was tell us about your current projects, because I know that you have obviously you're partnering with obviously some people on this call, some people on MIH not on this call, and you have properties all over. So maybe just tell us what you're working on the real estate side this year.
Sure. I was just in the last 2 weeks, not the whole time, for a few days each week. I've been in Alabama looking at deals in kind of primary market. Um, there's stuff out there. There's definitely stuff out there. I think the best thing to be doing right now is trying to contact sellers that you can get on the phone with. I think there's opportunity for seller finance and opportunity for distressed deals in certain markets. I've seen some stabilized A class stuff at like 6 caps. I think with debt potentially coming down into the fives, that's maybe not a bad purchase if you want an A class thing. And you can get fixed debt in the fives and you can be at a six cap, low expenses. You're not going to get a whole lot of brain damage managing it. I know this is something that Jay and I talk about a lot. Is the 2% cash on cash on a C class worth the brain damage you're going to get from it? Maybe, maybe not. But I do think it is a good time to buy. I think it's a good time to be underwriting hundreds of deals and looking at every possible thing, because if you look at asks and sell prices, there's a big delta between them right now. Um, I I had a project we were looking at. They were at 2.8 ask. We offered at 2.5. We're kind of back because we went and looked at it and maybe it wasn't as nice as we thought it was. We might be in the 2 range right now. And they've been amenable to all that. So um, yeah, I think just being in the game and underwriting things and making offers, and like I said to the broker on this particular deal, I said, there's what you're asking, there's what it's worth, and there's what a smart person is willing to pay you for it. And I'm only offering what a smart person is willing to pay, and they're not laughing you know, out of their network right now. So
I think you bring up a fantastic point, my friend, too, because those are really the three criteria, right? Like, you're going to pay what you're going to pay. You're going to pay what the numbers tell you you're going to pay, and that's it. I mean, there's no argument or debate or discussion about it. It's what the numbers tell you to do, and then the problem is you just can't be emotional about it. Reaching for properties, obviously, that you don't want to overpay for. So I love those three distinctions because that's really what we all do. You just verbalized it in a great summary.
I think a few times in the last month, I've been speaking to brokers about their values, and I think you can get to kind of a bottom line pretty quickly. It's like, what is the current actual NOI? What do you think a reasonable cap rate is? And it's typically going to price the property well below what they're asking. They're still asking for stabilized on pro forma, you know, um, and maybe a little more aggressive cap rate. So I always ask, like, what cap rate do you think it's going to trade at? And what's the current NOI? And I'm willing to pay pretty close to that generally for most things.
Anybody else have any questions for Josh? Don't be shy.
I guess I'll throw in a question, since we're talking about real estate, and that's what I absolutely love. So, Josh, I know we talk about this all the time, but I do agree with your initial point that you made about just kind of staying away from deep value add deals. I think we've kind of made the same decision as well. But now you just mentioned that brokers are still kind of pricing at pro forma. So if you're buying something that's relatively stable, relatively turnkey, you are going to potentially pay a fair market price for it, maybe not a steal, but a fair market price. So if you have partners or investors involved in those types of deals, for underwriting purposes, like, are you just using CoStar data? Because the thing is, like, for the past 15 years, like 2010 through 2022 or so, the 3 or 4% rent growth that was happening, most times you were actually getting more than that. Cap rates were decompressing, but now it's kind of going all over the place, right? There are years when it's flat, years when it's negative, years when it's 7 to 8%. So predicting returns and doing pro formas is a lot more challenging. So at least conservatively, what would you do? And would you basically just use CoStar IRR as kind of your source of truth for the best possible projections?
A couple things. CoStar, yes. I think knowing your market intimately. I think if you're spread across a lot of different markets and maybe you don't know all the other owners in your market, you don't know kind of their rents and other things, it makes it more difficult. But I think for me right now, um, if you're looking to own one of the nicest, newest things in town, I think there's a subset of people always willing to pay um, for that. So I think underwriting a 2%, 3% rent increase on A-class stuff is probably reasonable across most markets. There are some that there are some big FOMO markets like a Phoenix. I wouldn't do that. In Atlanta, I wouldn't do that. Um, but in most other ones that are kind of, reasonable demand, reasonable appreciation over the last 15 years, I think that's probably fine. On C class, I'm underwriting everything flat, no growth. I think for a C class right now, it's just a basis play.
So
You just
essentially,
want
you're
the
saying
lowest
if you're buying
basis.
C class, you're just buying for in-place cash flow, no growth.
Yep.
You're just going in for the cash flow. As long as it makes you decent money going in, you would
Yeah.
consider it. Okay.
Yeah, and again, that's
Got it.
also market dependent. I mean, in certain markets where it's super, super stable and there's like no building, yeah, great. But in Huntsville or in Atlanta, you can't do that. You got to pay for whatever's in place. There's too much being built, there's too much absorption issues. And then in a place like Atlanta, there's so much economic delinquency. It, you have to be underwriting for like an 82 economic occupancy. You are not getting it to 92. Ask me how I know, you know. So, yeah,
And
flat.
when you say flat, just kind of double clicking on that point, would you say your income growth and expense growth canceling each other out? So 3% expense growth, but 3% income growth? Because if income stays flat
No,
and expenses go up, you're actually, why would you even buy it? You're going to lose money over time.
the basis. You
Okay.
have like I'm looking at if it's C class, I'm looking at a good discount from market, a good discount on the basis because expenses will go up, and I'm still not sure that rents will go up. You know, obviously, when you're buying it, there has to be a great business plan too. Like, it's just, you know, there are some other, I guess, things to consider, like where is the asset? You know, is it in path of progress? Things like that. But in general, um, underwrite it with no income growth and kind of see where you're at.
So you also underwriting for no refi event also, and just kind of stay steady and hold in that situation? And there's not a lot of value add or?
Typically, yeah, typically I'm looking, like I said before, I'm really looking at more C class that's really messed up where I can create my own value, where it's like bombed out, bombed out. So like 50% kind of discount to market, right? Those are the ones that I'm more interested in. Just a C class that's kind of like stabilized ish, and they're trying to sell it for market, unless it's got something really going for it. I wouldn't look at it, and I would underwrite it flat and just offer based on current cash flow. You know, as far as refinance events go, I on just one that I'm buying at a discount to market on cash flows, I would not underwrite for any kind of big liquidity event. If it's a value add where you know you're going to create the value and you bought it at a price where you know you can do everything you need to do, because let's be honest, it's going to be a 70s thing. It's going to be galvanized plumbing, it's going to be galvanized mains. You're going to have to do a lot of different infrastructure improvement so that you know your expenses are going to be low on a go forward, and then create all that value and then capture it and then just run it from there, right? So um, anything stabilized C class, just be looking to buy on cash flow and significant discount, and don't bank on a liquidity event. I think the last 4 years have shown you cannot buy that kind of stuff and bank on a liquidity event. So many people have gotten their asses handed to them. So
Without a doubt, Josh, those are great points, and we see time and time again, month after month over the last 2 or 3 years, that exact same situation is happening. So, yeah,
I think
great
Jay
insight.
can probably speak to it better than I can. I mean, I think he's had tremendous success doing value add, and I think he stays away from C class that's like quasi stabilized, right? He just understands that's not where the returns and value in the long term are. That's not where the liquidity events are.
Does anybody have any other questions for Josh?
Hey Josh, I have a quick comment on the real estate thing. So, would you recommend for somebody who's like just getting into business, right? Okay, so maybe not somebody who's just getting into business, but they have a little bit of experience. There's not these heavy lifts, like Jay just said, could be a gigantic headache, right? And there's a ton of risk and a real period where you can expect no returns. Would you recommend like starting with like a small opportunity near your house, if that makes sense, like a heavy lift 4 unit or something like that? Just something to get you going. I know you're at a much advanced state, but how about for like the smaller investors starting out?
I would say flipping houses is good starting off, so you understand kind of identifying value. You understand the different types of liquidity events that you can have. You understand the taxes. You've done all the things that you would need to do to own a bigger property. And flipping can be a single family house. It could be a 4 unit. It could be a duplex. It could be any of the smaller real estate vehicles. But I think that's a good place to start, because I think it's important to go full cycle on a few deals before you start buying 100 units. You know, you need to
Of course.
understand all the intricacies, and go full cycle. And full cycle might not mean sale; it might just mean a refi. But that's kind of where I would start.
Awesome. Thank you.
Well, if there's no other questions, Josh, thank you so much, my friend, for sharing your Saturday morning with us. And thank you for all the tremendous insight, not only in real estate, but in crypto. I know I took notes. and I tried to put as much info in the chat as possible. This is being recorded too, so if you want to obviously go back and listen to what Josh's thoughts and our conversation that we had, in case you didn't take some of the stuff down, no big deal. If anybody has a problem accessing the recording, just let me know. But Josh, I just want to say a big thank you to you, and thank you for giving us your time and your attention today, and most importantly, your knowledge.
Yeah, no problem. I put my contact info in the chat, so anyone who doesn't have my email or phone, it's in there if you want to talk about real estate or crypto. I'm always happy to do that. And I really thank you for all of you for taking the time to listen and help support other people who are in MIH. It's always nice.
Absolutely. Everybody, we thank you for joining us this month. We will see you next month. And have a great weekend, and let's make it happen.
Thanks,
Thank you,
Josh.
Eric. Thank you, Josh.
Thanks, everyone.
Thanks, Josh.
Thanks, guys.
everyone.
Bye.
That's a wrap for today's 911 real estate call.
Thank you so much for attending, sharing your thoughts, and learning with us today.
Real estate isn't just about numbers, it's about creating intentional moves and finding opportunities that align with your goals.
Whether you're saving lives, leading a business, or growing your investments, the goal is to make your money work for you.
Stay engaged, keep learning. Let's keep pushing forward towards financial freedom.
We look forward to seeing you on our next call.
Until then, stay focused,
Stay connected, and keep building wealth
one property at a time.